We would like to take a moment now to thank our participating partner firms for this event, Hawkins, Parnell, Thaxton, and Young, LLP. We invite you to visit their respective website. Attendees, we encourage your questions, again, via the chat window on the lower right-hand side of your screen. You do have a terrific opportunity to interact with key thought leaders and experts in this area. And we want to thank our speakers for being so generous with their time and support to prepare for today's event. We're joined by David Johanson, partner in charge of the Napa office of Hawkins, Parnell, Thaxton, and Young, LLP. Offices in Napa, San Francisco, LA, and New York. And David has more than 20 partners, associates, paralegals on his team at Hawkins, Parnell, Thaxton, and Young. David and his team assist clients in general corporate matters and in employee ownership. We're also joined by Rachel Markun, partner as well in the Napa office of Hawkins, Parnell, Thaxton, and Young, LLP, who advises clients regarding the corporate tax and fiduciary issues relating to ESOPs. She represents retirement plan corporate sponsors in a variety of matters as well, including IRS audits and U.S. Department of Labor investigations. Speakers, just another quick reminder, please say next slide at the end of each page of your presentation or give us the slide number. With that, we can go ahead and start on page 12, and we'll turn our presentation over now to Mr. David Johanson and Ms. Rachel Markun. Please proceed.
Thank you, Elizabeth. You have a great WebEx voice. Thanks for the nice introduction. And Rachel Markun and I really appreciate the opportunity to be speaking with everyone today about one of our favorite subjects, employee stock ownership plans. Rachel and I will cover, starting on slide 12, I'm just going to give you a quick overview. We'll talk a little bit about alternative exit strategies, various opportunities to sell a business, and how they relate relative to an ESOP alternative, the criteria for evaluating those various alternatives, and then we'll focus in on the ESOP alternatives as a business succession planning tool, as well as a means by which you can motivate your employees, share equity with your employees, and accomplish a number of tax savings. We'll spend a few minutes on a profile of an ideal ESOP candidate, as well as talk a little bit about how corporate governance works in an ESOP company. An ESOP company works a little bit different than other corporations in this respect, and we'll share that with you. Basically, we'll talk about how an ESOP works in general. Next slide, please. The ESOP plan design considerations, we're on slide 12. Next slide, thank you. The ESOP plan design considerations is another topic that Rachel will probably focus more on than myself. I'll also turn it over to Rachel to talk about repurchase obligations and how companies typically focus on accomplishing the repurchase of their stock after they've sold stock to an ESOP in the first place. Corporate versus ERISA fiduciary standards will be a major topic of discussion today because in that ESOPs are part of the Employee Retirement Income Security Act of 1974. They have a number of ERISA fiduciary standards applicable to them, and critical oversight by the U.S. Department of Labor requires one to spend a lot of time focusing on whether or not you're meeting those ERISA fiduciary standards when accomplishing an ESOP transaction and related compliance matters. We will talk about, at the end, basically a summary of the pros and cons of an ESOP, and then hopefully we'll have plenty of time for questions. We do encourage you to ask questions throughout rather than let us sit here and talk the entire time. We'd rather focus on what you're interested in as opposed to the way that we focus on this subject matter. One thing I will say before I go on to slide 14 is that in order for an ESOP to work better than one could imagine, you have to combine not only the tax and corporate and employee ownership incentives associated with an ESOP that we'll talk about and the financial benefits, but you have to focus on communicating that program and the plan to employees. So creating an employee ownership culture is a key part of the success of any ESOP-owned corporation. Next slide, please. First, let's talk about the alternative exit strategies. One thing you could do is you could sell to a strategic buyer. There's a lot of strategic buyers out there these days. They have a lot of large, either closely held companies or publicly traded companies are out there buying companies because there's a lot of cash available to accomplish those transactions. The complication from a closely held business owner in accomplishing a transaction like that is that typically they're coming in, they're looking for some major strategic advantage of buying you. After the transaction closes, the world as you know it will change. Some of your key officers and employees may not have jobs after the transaction is completed. So it's got its drawbacks in that respect. Another alternative that the potential clients in this area focus on is a financial buyer, a private equity group that's out there buying companies. Again, there's a lot of cash available. The financial buyer isn't going to pay as much as a strategic buyer, generally speaking, because they don't have the same strategic reasons to accomplish the transaction, and typically those transactions will be highly leveraged. Again, you may or may not see a lot of shift in employee ownership, meaning key employees losing jobs in a situation like that. It depends upon the circumstances. Finally, an ESOP is an alternative for selling your business. Again, the ESOP, we have to keep in mind the ESOP is governed by the Employee Retirement Income Security Act of 1974 as amended, ERISA, so that carries with it substantial and significant ERISA fiduciary responsibilities. That said, it also carries with it a number of tax incentives for the corporation and for selling shareholders, as well as employee equity incentives for the employees as a whole. Rachel, any quick comments you have about alternative exit strategies before we move on?
I think it's important to realize for a business owner considering an ESOP, a sale to a strategic buyer, or a financial buyer, that the evaluation process can include multiple alternatives. Oftentimes, it's a letter of intent that comes in from a strategic buyer that leads a business owner to the decision-making that would consider an ESOP or other exit strategy. So certainly, it's entirely permissible to proceed on multiple fronts to determine the best business succession strategy for your corporation.
Thanks, Rachel. Good thought. Could we go to slide 15, please? So now let's focus on what criteria you should examine when evaluating the various alternatives that Rachel and I just talked about. First, purchase price. Again, with a strategic buyer, you're going to get probably the greatest price. So if you're looking for the greatest price to accomplish a sale of your business, an ESOP probably is not the best alternative because, number one, a strategic buyer is going to pay more, and number two, with ESOPs that are governed by ERISA, an ESOP trust cannot pay more than fair market value for the stock. So that constraint itself is something that owners should think about. That's why typically owners are, when they're evaluating an ESOP alternative relative to a strategic sale, they think, yeah, I might get a lower purchase price, but I won't potentially pay any taxes on the sale proceeds if I'm a C corporation and I take advantage of Section 1042 of the Internal Revenue Code, which we'll talk about later. And I'll share equity with my employees, and my management team that I've developed along the way will be able to continue along the way with the transaction, and I'll be able to tutor them as I move into my retirement years, and hopefully this will be a successful opportunity for me to stay involved in my business a little bit and help it accomplish a transition. Secondly, personal and corporate tax considerations. Two of the major advantages we see with ESOPs relative to strategic sales are that corporations can accomplish major tax deductions, which we'll talk about in this presentation, related to accomplishing an ESOP transaction. So now, if a corporation is funding a $5 or $10 million transaction involving a sale to an ESOP, they will be able to create whatever debt is incurred to purchase the stock in the first place, or the purchase price itself is generally being able to be sheltered through tax deductions under the Internal Revenue Code at the corporate level. Also at the personal level, Rachel and I will talk about deferring your taxes under Section 1042 of the Internal Revenue Code. So if you think about an ESOP alternative relative to a strategic sale or a financial buyer sale, the ESOP alternative can compare quite nicely because you'll accomplish tax savings at the corporate level of potentially 45 cents on the dollar in any state in the United States, and the selling shareholders will accomplish potentially a tax deferral on their sale proceeds, which could amount to, in California, for example, with the tax rates as they are right now, a marginal tax savings of 37%, 37 cents on each dollar. Form of consideration with any one of these alternatives is typically cash, stock, or a combination of both or other assets. One thing we want to look at when we're focusing on deciding which alternative to use for purposes of transition in a business is wealth diversification and liquidity concerns. Wealth diversification, we typically want to move our assets out of a closely held business and into some security, either securities, marketable securities, or real property, or some other form of security that transitions our wealth from a closely held business environment to a diversified portfolio of assets, including potentially real estate, stocks and bonds, or municipal securities, etc., money market funds. Liquidity concerns are something, Rachel, would you like to talk about that as it relates to an ESOP compared to a strategic sale?
Sure. The real question from the standpoint of business owners evaluating whether or not to consider an ESOP alternative is oftentimes saying, I've maintained this business for many years. This is my primary asset, the wealth diversification that you mentioned. Do I need immediate liquidity in this business sale? Am I looking for an all-cash sale? Now, buyers would always prefer to receive all cash. However, there is going to be, in any business negotiation, whether it's a strategic buyer or a financial buyer, a significant limitation associated with an all-cash purchase. ESOPs do offer the ability to leverage, as we'll describe in the course of this webinar, and allow the individual business owner to receive the sale proceeds over time. So to what degree is liquidity critical for the business sale, and to what impact do the favorable tax considerations that an ESOP seller can take advantage of? If you're not immediately dealing with the tax hit of a business sale, oftentimes there's a great deal of additional flexibility for a business owner in saying, I'm comfortable receiving the proceeds from this business sale over a 5 to 7 year horizon, or whatever appropriate period of time would be considered.
And that's typically how most ESOP transactions in today's world operate. Very rarely is there an opportunity to accomplish lending, or borrowing from a bank that allows the selling shareholder to sell to an ESOP trust and then take the proceeds and diversify them into other investments, because typically the lender wants collateral, and in most companies don't have the collateral necessary to accomplish the borrowing that occurs to accomplish the transaction. So typically an ESOP transaction involves payment over time, over a 5, 7, 10-year period of time, but in return you get the benefit of selling to your employees, potentially deferring your taxes, and accomplishing major corporate tax deductions in the process. Another thing you should look at when selling your business is legacy. If you sell to a strategic buyer or a financial buyer, you really probably don't have much in the terms of legacy that you're accomplishing, I would say. With an ESOP, typically the company becomes quote-unquote employee-owned, and you preserve that organization and the culture of the organization for the employees who helped you build the business in the first place. And that's a lot of what goes into convincing most selling shareholders and founding shareholders to use an ESOP to accomplish wealth transition. Alignment of management and employee incentives is a key advantage of an ESOP alternative relative to strategic sale or a financial sale. And then time to close. I think all three versions, a strategic sale, a financial buyer transaction, or an ESOP, can all be accomplished, quite frankly, within a period of 2 to 4, as much as 6 months, sometimes longer. Let's next slide, please. Rachel, you want to introduce us to what an ESOP is? We're talking about an ESOP. I guess we haven't even said that the acronym stands for Employee Stock Ownership Plan. You want to take us through the next slide, please?
Sounds great. The ESOP plan document, actually, if we could go back to the prior slide for our introduction. The ESOP plan is a form of retirement plan. The ESOPs are subject to regulation by the Internal Revenue Service, with its authority over the Internal Revenue Code, and by the United States Department of Labor with its authority over the ERISA Federal Retirement Statute, the Employee Retirement Income Security Act. So as a retirement plan, this dual federal regulation adds some complexity and a number of rules associated with the ESOP form. There are significant tax advantages of ESOPs that we will detail for selling shareholders and corporations sponsoring the ESOPs, but the corollary that a business sponsoring an ESOP faces is that there will be significant rules associated with those savings. Some of those rules apply to all types of retirement plans. For example, the standard 401k plan that most businesses sponsor today is also a retirement plan that is subject to regulation under the Internal Revenue Code and ERISA. There are specialized rules for ESOPs under these statutes. The first key is that the ESOP is designed to invest in what's termed employer securities in the statutes, what we will call here as primarily company stock, securities of the corporation sponsoring the plan, securities of the employer whose employees are covered by the plan. And in general, in a 401k or other type of profit-sharing plan or pension plan, there is a 10% limitation that applies for investments in this company stock. That does not apply for ESOPs. ESOPs are designed to invest primarily in company stock, and in many cases, the sole asset of an ESOP will be the company stock. What that means for the vast majority of ESOPs that are not sponsored by companies that have securities publicly traded on a securities exchange is that the trust for the ESOP that holds that company stock is holding illiquid assets. And a great deal of the code and ERISA regulation associated with monitoring the ESOP process is ensuring that that employer will provide liquidity over time to the employees, generally speaking, following their termination of employment or retirement, so they get the value of the company stock that they have received. There are some specialized diversification rights that are presented for ESOPs to allow long-term employees who have attained age 55 and have worked for the ESOP company for a period of at least 10 years after that ESOP has been in place, to diversify a portion of their account balance, generally 25%, and once they attain age 60, the potential for 50%. Next slide.
So here, we'll just jump in quickly and try to go through a number of other key points about just on a basic introductory level. ESOPs are not subject to any minimum funding requirements like defined benefit pension plans under Section 412 of the Code. So you don't have to put anything into an ESOP unless you accomplish a leveraged transaction, and then you have to put enough into the ESOP trust so that the debt can be amortized by the ESOP over a period of time. And typically you'll have contributions going into the ESOP trust to amortize that debt over a 5, 10, 15-year period of time, and you'll also have a mirror obligation from the corporation to the selling shareholder, or potentially from the ESOP to the selling shareholders. What we've talked about a couple of times now is Section 1042 of the Code. Under Section 1042 of the Code, and we'll talk more about this down the road, if an ESOP is set up and it's for a C corporation and the selling shareholder sells at least 30% of the issued and outstanding stock to the corporation, of the corporation to the ESOP trust, and reinvests the proceeds from that sale, or an equal amount of proceeds, in stocks or bonds of U.S. companies, that selling shareholder can defer his or her tax on the capital gains that would be incurred in connection with that transaction. We'll talk more about that down the road, but that's one of the major advantages of accomplishing an ESOP transaction. There are limitations on that. If you've got a family and the family is actively involved in the business, you cannot accomplish this Section 1042 tax deferral and allocate any of the stock that's sold to the ESOP or to family members, certain family members, as well as any other 25% or more shareholder. Those are restricted. So typically what happens if you've got family members involved in the business and you're selling to an ESOP, you're going to accomplish non-qualified plans to share some of the value of the company with those family members who continue to participate in an ESOP company after a Section 1042 transaction is accomplished. And I will point out that the Senate recently passed a version of a bill that would extend this Section 1042 tax deferral to S corporations as well as C corporations. That's been in the law one way, shape, or form or another for many years. We'll see if it gets passed this year. Hopefully it will. Next slide, please. The next slide, thank you. ESOPs can be leveraged as well as non-leveraged. Again, we need to move on to the next slide, thank you. ESOPs can be leveraged, which effectively doubles the limit on deductible contributions for C corporations only. Contributions for general plan administration purposes are deductible under Section 404A3. Typically, you can get one level of deduction there, as well as under Section 404A9 of the Code. Under 404A9 of the Code, that is the section that deals with leveraged ESOPs. And so with Section 404A9 of the Code, not only do you get to deduct 25% of the covered payroll of the employees who participate in the ESOP for purposes of paying principal down on the debt that's incurred to buy the stock from the selling shareholder, but you also can accomplish a interest deduction, so any interest on the debt could be deductible as well, and then deductible dividends under Section 404K of the Code. We do need to move to the next slide. I'm now moving to slide 19. So, excuse me. Yes, 19. Thank you. Let's look at the benefits to the various participants in an ESOP transaction. First, employees. There's no deduction from their wages, so they don't have to, employees typically in an ESOP company have been shown to make more compensation generally than other companies pursuant to a Rutgers study that's been out there for a long time. Furthermore, employees don't have to put any of their wages into accomplishing an ESOP transaction. The company is going to use their profits and use those to purchase the stock from the selling shareholder. The value of the ESOP benefits, the stock, the company stock that's held in the trust typically, may grow over time. It may decline, but it may grow, and in many cases it does grow substantially over time. And that could be a very good retirement benefit based upon the performance of the company stock. The negative here is that, there are some situations where an ESOP purchases company stock from founding shareholders and the stock doesn't do very well at all, and in some cases it could actually go out of business. So there's potential that the employees lose everything that the company invests in accomplishing the ESOP transaction. Not very often, but it does happen. Next slide, please. Rachel, you want to talk about the difference between beneficial ownership and legal ownership for a few minutes?
Thank you. The concept of the ownership rights for participating employees, typically referred to as participants or beneficiaries, is derived from the general trust law, where the trustee is considered to have the legal ownership. Oftentimes that is termed to be the record owner in the context of stock ownership, record ownership for the determination of the dividend date, whereas the participating employees, their rights are simply a beneficial ownership. They do not actually hold the stock certificate of the shares owned by the ESOP, the company stock owned by the ESOP, but they have beneficial rights. The trustee acts for their benefit in holding those shares of company stock. The terminology that's very popular in today's ESOP community is that the participating employees are employee owners, and that's accepted terminology. The government regulators are comfortable with that terminology, but technically the legal ownership for the shares rests with the trustees and not with the employees themselves. The employees have the rights with respect to the shares and will be entitled to receive the economic benefits associated with the shares, but that's carried out by the legal owner, the trustee that manages the ESOP trust. We took the opportunity here to explain a few of the things that an ESOP is not, and we include that because oftentimes there's confusion as to what this ESOP vehicle is. An ESOP is not a direct stock purchase plan. Stock purchase plan, as many of you know, allows a corporation to grant its employees a discount from the publicly traded price of those shares up to 15% of the price of the shares, and there's regulation as to how that is structured under Section 23 of the code. That is not an ESOP. The ESOPs that we're talking about are primarily held by non-publicly traded companies. The ESOP is also not a stock option plan where individual employees, participants, executives will be granted the right to acquire company stock at a future date. And the world of stock options, the regulatory rules associated with that essentially means that the employee who receives a stock option will get the economic benefit of the appreciation above the fair market value price at the time that that option is granted. The ESOP trust itself holds the entire share, not just that future appreciation, and it's distinct from a stock option plan. Oftentimes, one will find stock option plans for an executive team operating in parallel with an ESOP so that the management of the company, the ESOP company, is well aligned with the interests of the ESOP. But an ESOP is separate and distinct from stock option plans. It can operate in conjunction with stock option or stock options are not necessarily required with respect to that. Next slide.
So now let's look at the advantages of selling to an ESOP for a selling shareholder. Obviously, we've talked about it before, and we'll go into it in more detail down the road. The tax deferral under Section 1042 of the Code for C Corporation ESOPs is powerful, substantial savings. Furthermore, an ESOP is a tool that a selling shareholder can use over a period of time to still stay involved in the business, help tutor the transition of the business to the next generation of employees of the business, and partially or completely transition ownership over a period of years. So great opportunities for a balanced approach to selling your company over a period of time to your employees through an ESOP for a selling shareholder. Next slide, please. The advantages to a C corporation are substantial. Tax-deductible contributions to an ESOP can be, as I've said earlier, up to 45 cents on the dollar of each dollar of taxable profits can be used to accomplish tax deductions in handling transactions involving the transition of ownership of a company to an ESOP. We've gone over sections 404A3 and 404A9 already, the two major sections for these tax deductions. Those have been in the code for for a number of decades. So these are some deductions that we haven't seen been challenged by the Internal Revenue Code or the Internal Revenue Service for many years. Very typical tools used in accomplishing ESOP transactions. Also, from a corporate side, let's say that your eligible compensation, as we talk about on this slide, is not substantial relative to the value of the company. Let's say you have 50 employees and you've got a $10 million or $15 million value of the business. Then you may be in a position where 25% of the eligible compensation puts you in a position where you cannot put enough money into the ESOP over a period of years to sell the business over 25 or 30 years. So what can happen is, with that situation, you can accomplish tax-deductible dividends. So if the value is relatively high compared to the number of employees that would create your eligible compensation, and there's not enough of a limit with that 25% of compensation to put money into the trust to accomplish the sale in a 5, 10, 15-year period of time, and you're looking over a 25 or 30-year period of time, the company can supplement those contributions, the deductible contributions, with deductible dividends under Section 404K of the Internal Revenue Code. Those deductions are for reasonable dividends that are used, and typically they're used by the ESOP to repay the debt that's incurred to buy the stock from the selling shareholders, and that they're deductible. They're the only type of deductible dividends under our Internal Revenue Code. Next slide, please. There's also one of the things that happened in the mid-90s is that Congress passed a law that allowed S corporations to accomplish ESOP transactions, and now instead of just having C corporations doing this, S corporation can be owned by an employee stock ownership trust. And what that does for us is, with an S corporation, there's no shareholder level tax, and there's no corporate level tax. There's only a shareholder level tax. So the corporate income is passed through to the ESOP trust. If we understand that the ESOP trust is tax exempt, we now know that if an ESOP owns 100% of a closely held corporation, then there's no corporate level tax. We save all of those taxes, and at the ESOP level, if 100% is owned by the ESOP trust, then there's no shareholder level tax because you've got a tax-exempt trust owning the shares of stock. And we've seen the growth of a lot of closely held businesses into the tens and hundreds of millions of dollars because of these tax savings. And the tax savings inure to the benefit of the employees because the employees get a greater value, presumably, as the the value of the company grows because the company doesn't pay any taxes, and the taxes are used to productively for CapEx, debt repayment, acquisitions of other companies, etc. Next slide, please. I think we've kind of already covered that, so I'm going to try to move on because I want to make sure we finish in time to get to questions. So we'll move on to the next slide. That's just a little bit more of what we've talked about, the cash flow advantages of the tax deductions. So we'll jump on to slide number 26, which is profile of an ideal ESOP candidate. Rachel, you want to start with the selling shareholder characteristics, and I'll cover the other two, please.
Thank you, David. The selling shareholder looking to take an existing business, oftentimes a business that selling shareholder has developed, from a very small operation to a successful operation over time. You have to have a selling shareholder who is looking for fair market value but is not attempting to achieve the type of strategic pricing, looking for the strategic buyer who is trying to enter a market, looking to pay in excess of fair market value. The regulatory structure that we've described mandates that the fair market value of the ESOP sale be carefully documented through the structure of the transaction. So the shareholder has to be comfortable with that approach. Typically, the selling shareholder will have as, generally, their largest asset, the ownership in the stock of the company that they're considering selling to the ESOP. And that stock is frankly not liquid. In another era, it might be the type of situation where the seller would say to the key lieutenants, would you like to buy into this company? But typically in the ESOP context, though that next level of management will not have the economic wherewithal to pay a fair market value. So, looking to diversify that investment, being interested in the types of tax-deferred benefits associated with an ESOP, which we'll continue to describe under Section 1042, which will allow a seller to avoid current taxation and potentially through the holding of qualified replacement securities in publicly traded U.S. stocks and bonds, can avoid any tax on that amount. You clearly are going to want to have a business owner looking to the corporation that he or she has built or the team has built and say, this is a corporation that I would like to continue in the community, continue in the 15 states that we've evolved to. I'm grateful to the employees who've helped us move to this direction. We'd like to preserve this corporate name, the impact of this corporate participant in our industry, and to continue the opportunities there. So the legacy factor, the ability to address that and really to recognize that the employees have built a key amount of the value that's inherent in the stock that the selling shareholder holds, and wanting to have those employees continue and receive the future economic benefits over time. All key seller shareholder characteristics. Last one that we did not include on the slide that I think is important to mention is that with a financial buyer or a strategic buyer, it's not likely that the selling shareholder will be able to say, I'm ready to sell a portion of my business and I would like to continue in the president's office for a period of the next 2 to 4 years while management transitions and is ready to move over. Typically with a third-party buyer, at the conclusion of the acquisition, the determination of whether that selling shareholder stays or goes is entirely in the buyer's hands. So the selling shareholder who is looking for a longer-term transition and an evolution of their exit from the business often can find an ESOP to be quite attractive.
The next slide I'd like to cover is the profile of an ideal ESOP candidate from the perspective of a sponsoring corporation as opposed and the employee characteristics. So here, the one thing we want to do is we want to make sure that we've got a company that's got sufficient balance sheet strength to absorb the acquisition debt. And the way we look at that is we look at the tax returns and the financial statements of the corporation over the last few years, and we see, is the company generating profits? Is the company paying taxes? Is the company generating cash? If we do that, we know that the company is going to be able to amortize the debt over a period of time. The next question is, in this whole subject area, is what kind of profit level does the company have? Is the company generating the profits, not just the cash, but is it generating profits? Profits are key to success in any well-run ESOP company. If you don't have this financial strength, the balance sheet strength, and the profit strength from operations, you shouldn't be thinking about an ESOP because ultimately it probably won't work. And you have to think about this subject matter not only today, but historically. How has the company looked, and what does it look like going forward? What are the company's prospects for the next 10 years, if you can look down the road? Next slide, please. Again, from a sponsoring company and employee characteristics, typically we want to have a substantial payroll. I can't see an ESOP working with any less than 10 to 15, 15 to 20 employees or more. We have seen smaller ones. They've actually worked quite well, but it's challenging with a smaller number of employees, as Rachel can tell you as well. It's got to be sufficient payroll to amortize the debt that's incurred to buy the stock from the selling shareholders. You have to have a management team. If you don't have a management team, you're not going to succeed with an ESOP as well. Participatory management environment is critical. If you've got a dictatorial environment where management runs the company with an iron fist, probably is not the ideal environment for an ESOP company, because typically what you see in ESOP companies is employees working together with management to accomplish great things for the company in terms of profitability and paying back the debt that's incurred to buy the stock in the first place. Then you want to have effective communications between employees and management, and quite frankly, although there are different technical issues related to S corporations and C corporations, both are effective candidates for an ESOP. Next slide, please. The corporate governance in an ESOP company is unusual. Rachel, would you like to describe that, please?
Sure. Let me start by saying that many of the clients that come to us to address ESOP issues are often worried that they have not observed the corporate formalities from time to time as they've continued their business operations. They've paid attention to growing that manufacturing facility, growing that sales force, and not paying attention to the corporate minute book. That is not an obstacle to the introduction to an ESOP where the selling shareholder has been not only in that shareholder role, but the officer and the board of directors. The corporate formalities are less important. When an ESOP comes into place, the corporate formalities do need to be observed. So let's move to the next slide, and we're going to quickly go through several of the key points of corporate governance in an ESOP company. What we want to emphasize here is that there needs to be attention to the rights to the ESOP, but it's not a situation where everything changes. It does not transform employees into the board of directors. It does not disrupt the strategic plan or the various management hierarchies that you need to have within a corporate setting. The standard of having the board of directors who oversees the officers, appoints the officers, will always continue with an ESOP company. Once you do have an ESOP that owns employer securities, you will have that trustee that sponsors and oversees the ESOP trust holding the assets, acting as a shareholder along with the non-ESOP shareholders. David described under Section 1042 how an initial sale to an ESOP would need to be at least 30%. So in a typical situation, you might find after an ESOP has been implemented, the ESOP trustee having 30% of the shares and the original founders of the company holding 70% of the shares. And together they would elect the board of directors for the company. In the ESOP situation, one often finds an ESOP advisory committee. That's not a mandate in an ESOP company, but it oftentimes facilitates the communications that are described. Let's go to the next slide and just go over the key roles that will be played by the parties. The ESOP trustee, as a shareholder, will be involved in the election of the board of directors, as will be any other shareholders. Will address the ESOP administration, the rights of all of the individual employees, and as a statutory matter, will not only determine the appropriate price for the acquisition of the shares in an initial ESOP transaction that we will diagram for you in a few minutes, but will also establish the fair market value on an annual basis. The board of directors continues to have responsibility for all major actions, for strategic planning, for appointing the officers, and critically also appointing the board of trustees, the ESOP trustee, to oversee the ESOP. The corporate officers continue to be responsible for day-to-day management of the corporation. So here, for the board of directors, the corporate officers, we're not dealing with significant changes. And one of the key points for many businesses considering the ESOP structure is to ask, will we be able to retain our existing management structure? And by and large, you clearly can do that. Now let's turn to the next slide. The ESOP Advisory Committee, as I mentioned, is going to be an optional provision. Typically, this committee is deployed to have interaction with the employee owners so that they can describe in more detail how the ESOP functions, sometimes dealing with orientation for new employees who will become ESOP participants, and just general communications to the ESOP sponsors' employees. It's often the recommendation that David and I make in the course of representing ESOP companies to add committees to that board of directors structure. Most of the committees that we see for an incoming company will have a finance committee. Oftentimes there's a small board of directors that's never functioned with committees. When you have this additional corporate governance structure, one of the ways to ensure that that is not disruptive to the general operations of the board of directors and yet attentive to the additional responsibilities is to put in place a nominating committee to ensure that the board of directors recommends appropriate directors to the shareholders for voting, a fiduciary committee to oversee the actions of the ESOP trustee, an audit committee if one has not in place to review the annual audit of the company's financials, if those financials are in fact audited, not a requirement in an ESOP company, but often something that one finds. And then typically a compensation committee, an executive compensation committee, to ensure that the compensation paid to the corporate executives is reasonable and appropriate. And oftentimes that's involved in hiring a consultant who has that expertise, who has the data for the industry in which the ESOP sponsor operates. So those types of committees oftentimes operate to streamline many of the ESOP company structures.
Rachel, I think we should move to slide 36, and I will jump in there, and let's talk about how an ESOP works in non-leveraged, leveraged, and then the 1042 tax deferral and the advantages of those, and try to move closer toward the end of our presentation here. First, with a non-leveraged ESOP, typically what happens is you set up an ESOP trust and a plan document. You get them qualified under the Internal Revenue Code. You obtain a favorable determination letter from the IRS with respect to their qualified status. And after you've done so, the corporation is able to make tax-deductible cash contributions and or stock contributions to the ESOP trust. Rachel and I have worked on a number of transactions in which, over the years, over 30 years, in which the corporation has set up a non-leveraged ESOP, contributed cash to that non-leveraged ESOP trust. The cash is built up, and over a period of time, then the cash is used to buy stock from the selling shareholders of the corporation, the founding shareholders. Then, basically, as that cash is contributed, the cash is allocated to employees' ESOP other investment accounts. When the cash is used to buy stock from the selling shareholders, the cash in the ESOP accounts over on the right-hand side of the chart here is converted to stock, and then that stock either increases or decreases in value or stays the same over a period of years. When the employee reaches either retirement age, which would typically be 65, passes away, has a total and permanent disability, or leaves the company and is vested in his or her account balance, then the employee has an opportunity to basically take that stock and or cash benefit in their ESOP accounts, converts it entirely to cash. The company has to repurchase any stock that's in the employee's accounts over a period of years, and the cash that ends up in the employee's hands can either be spent in retirement or rolled over in a tax-free manner to an individual retirement account or IRA. And at some point, that's why Congress provides all these tax deductions for ESOPs, because even though the corporation gets deductions at the time that it's set up, at the time that the employee receives the retirement income either from the ESOP or from the IRA after converting the ESOP stock to cash in an IRA, the employee then pays taxes. And so the Internal Revenue Code and the U.S. Treasury gets their tax revenue at that point. Next slide, please. The next type of ESOP that we typically work with is a leveraged ESOP. And again, we talked about the fact that You don't typically see too many bank-funded ESOP transactions. There's a few, but that's not very typical, because in order to accomplish those transactions, either the selling shareholders need to guarantee the bank debt, or the company needs to guarantee it, or the company needs to have sufficient assets, liquid assets, either capital equipment or real property or cash to provide collateral for the loan, and that doesn't happen all the time. So a lot of the times what happens with the leveraged ESOP is the selling shareholder simply decides to give an IOU to the ESOP, or to take an IOU from the ESOP trust. Selling shareholder transfers his or her stock to the ESOP trust. ESOP trust then receives tax-deductible contributions from the corporation, which the corporation uses to repay the selling shareholder over a period of time. And Rachel and I have also typically seen these transactions work in such a way that if the selling shareholder is not interested in a tax deferral under Section 1042 of the Internal Revenue Code, the corporation will simply redeem or repurchase the stock from the selling shareholders and then sell that stock to the ESOP in a leveraged transaction in which the corporation pays for the stock over, or the ESOP pays for the stock over a period of time with tax-deductible corporate contributions to the ESOP. Again, the employee side of this typically works the same way. As the debt is repaid, either the debt from the selling shareholders from the ESOP to the selling shareholders, or the debt from the ESOP to the corporation, as that debt is repaid with tax-deductible contributions from the corporation, then stock is released for allocations to ESOP participants' accounts, and the release happens basically according to relative compensation for the employees. So if I earn 1% of the compensation of the eligible employees, I'll receive 1% of the stock that's released for allocation to my accounts. One of the things on the leveraged ESOP that employers and founding shareholders get concerned about is they say, well, hey, I've got to pay back all this debt that's incurred to buy stock from myself. And then, at the end of the day, when the employees have this stock in their accounts, I've also got to repurchase the stock from the employees, and that's called repurchase obligations, which Rachel will talk about a little bit later. Typically, you can set this up so that the debt that's incurred to buy the stock, the leverage that's incurred to buy the stock in the first place, it takes priority. So until that's paid off, the internal loan between the corporation and the ESOP, or the ESOP and the selling shareholders, until that's paid off, you can make a moratorium basically on making distributions of stock to terminated vested ESOP participants, and therefore you can defer your repurchase obligations associated with the ESOP. Next slide, please. Rachel and I have talked a number of times about the tax-deferred reinvestment under Section 1042 of the Internal Revenue Code. That's currently for C corporations only. It may be expanded to S corporations this year. It depends on if the House votes in favor of that same bill that the Senate just passed. And the President's got to, of course, sign it into law. Here, basically, if a selling shareholder owns 30%, roughly 30% of a company, at least 30% of a company, all of its classes of stock, and sells that to the ESOP, and then converts that, or not, doesn't necessarily convert it, but then purchases stocks or bonds of U.S. company, that's referred to as qualified replacement securities or property in this slide. If that occurs, and that happens within 12 months after the sale to the ESOP, or 3 months before the sale to the ESOP, that the repurchase or that the purchase of debt or equity of domestic operating companies occurs, the QRP, the qualified replacement property, then the selling shareholder can defer his or her taxes on the sale proceeds to the ESOP, and that's a powerful tax advantage. Could be as high as I said, in California, the marginal tax rate on capital gains and ordinary income for sales of stock to an ESOP trust could be as high as 37.5% with the new ACA tax, because you've got 23.5% roughly capital gains, as well as ordinary income taxes that can, in California, be as high as 12 or 13%. Rachel, would you like to talk briefly about how you use floating rate notes to accomplish a transaction like that described in slides 38 and 39?
Sure. The concept of QRP was originally set up in the code to define the securities to be acquired as U.S. corporate stocks and bonds, and the types of exceptions that David mentioned for mutual fund assets, REITs, any type of passive investment, electronically traded funds, municipal bonds were excluded. The problem with the 1042 structure was that it was set up as a one-time deferral. Unlike the real estate like-kind exchanges where a real estate investor can defer taxation from property to property by making like-kind exchanges one after the other, the purchase of qualified replacement property is a one-time event for an ESOP seller. And there, for a number of reasons, that one-time event is important to occur with the type of security that an individual would want to hold for the remainder of their lifetime to get the benefit of the stepped basis, the fair market value basis at the time of their death. And that was a complex issue from an investment decision. You know, what are the appropriate securities for us to hold on a long-term basis? You know, that's always a complicated investment decision, but when you're looking to a time horizon that many ESOP shareholders have, 30 years, 35 years, 40 years, it's an even more complex solution. Wall Street came up with a solution in the form of the corporate floating rate note, and the solution was designed in the form of a corporate debt security that satisfied the QRP definition. It would be a U.S. company that offers its debt securities. Those securities were structured as long-term, 30, 35, 40, 45-year corporate notes, much longer than the typical 25-year long-term corporate bond. They were also structured as floating rate notes. Oftentimes the acronym FRN, floating rate note, is used because they were intended to really mimic money market type returns, to float with whatever short-term financial directive, usually a 3-month LIBOR type restriction. So not the type of significant return, but a very small interest rate return. Well, why would a selling shareholder be interested in that type of low interest rate structure? Because those floating rate notes were intended to be acquired by an ESOP selling shareholder and then to be leveraged by the shareholder with a corresponding margin loan. So the idea was to have the type of long-term financial instrument that would allow a selling shareholder to acquire qualified replacement property equal to the entire sales price to an ESOP. However, to leverage that so that the majority of those proceeds would be free to be used by that ESOP seller for a variety of purposes, whether it was retirement income or other investments. And with that floating rate note structure, which is not the sole type of qualified replacement property that is eligible to be acquired under 1042. We found a real growth in the U.S. companies that have offered these types of securities because of the demand for these under 1042 of the code. And I think, David, if we want to illustrate the tax savings, we might jump ahead to slide 40.
Yeah, I'll talk briefly about slide 40, and then we, again, trying to move things along here so we complete the presentation with a few minutes at the end for questions if there are any. On slide 40, this just brings together what Rachel was just talking about, and I'll kind of combine this also with the corporate tax deductions that we talked about as well. So if you've got $1 million purchase price and you don't pay capital gains and ordinary income taxes in California of 37%, you've got a deferral of that $370,000 worth of taxes, which could be a complete tax avoidance if you hold the QRP, the floating rate notes that Rachel talked about, until death, and you get a step up in basis and sell those floating rate notes at that time. So there's the potential for that $370,000 advantage on $1 million purchase price, and you can just multiply it by the value of your company to get to your results. And then also on the $1 million, if the company gets to take a tax deduction of up to 45 cents on the dollar on that $1 million of purchase price, that's also a substantial tax savings for the corporation in order to accomplish the sale. So the sale is being accomplished with pre-tax dollars, and there's a $450,000 advantage there. So you can see how the net proceeds related to a sale to an ESOP with and without a Section 1042 transaction tax deferral line up here, and then add in the corporate tax savings, and you've got potentially a really powerful tool to use for purposes of selling your business. I'd like to, Rachel, if you could cover just briefly plan design considerations and then briefly repurchase obligations, then we'll see what we've got left to cover today in our presentation.
Great. Let's move to the next slide. Plan design is generally addressed in the form of a feasibility study for potential sellers to an ESOP looking to determine, is my company the appropriate type of company to sponsor an ESOP, and most significantly for those shareholders to say, does workforce and does the demographic that we have in our payroll base support the ability to make substantial contributions to the ESOP to allow the company to use the types of deductions that David has described to fund contributions to the ESOP that in turn are used to pay the business owner. And that type of a feasibility study, the general Internal Revenue Code rules with respect to eligibility to participate are examined to determine what is the compensation base. An ESOP is a broad-based plan. In some instances, it can be more narrowly tailored. For example, an employer that has a large group of collectively bargained union employees, those employees can be excluded from the compensation base. Non-U.S. employees can be excluded, non-resident aliens with no U.S. source income. You can exclude any employees who have not attained age 21, and you can have an entry requirement of up to. The determination of the various factors for the eligible participants will determine what the wage base is for the ESOP company. That wage base in turn will define the deductions that David described. And so the feasibility study is used to determine the aggregate compensation that will generate the deductions. So for example, a potential seller to an ESOP will look at the demographics, look at the census, the W-2 income of its employees, exclude potentially non-U.S. employees, union employees, employees under the minimum age of service, employees who have not completed 1 year of service, employees who are not substantially full-time with 1,000 hours of service, and determine what type of deductions will be supported. So, for example, if that is done and there's a $4 million annual payroll, as David described, there's a general 25% deduction, a $1 million amount, potentially an additional 25% for a leveraged ESOP, potentially $2 million that could be contributed to an ESOP to reduce the taxable income of that ESOP company. So the feasibility study looks to plan design to determine. It also looks to the vesting that is provided, and the code provides certain rules with respect to vesting. It allows vesting for employee rights to be gradual, 20% after 2 years, fully vested after 6 years, or a cliff vesting with 0% vested until a 3-year period of time. And that analysis comes in conjunction with the moratorium that David described for determining the plan benefits, how the ESOP seller can be paid, and then over time after that ESOP seller is paid, what the obligations will be to the company. Next slide. Another part of the feasibility study is to say, do we have appropriate candidates to serve on an internal board of trustees, or are we going to hire an institutional trustee? What is the process for doing that to ensure that the fiduciary standards under ERISA we've described are met? And then to examine the future repurchase obligation. And let's turn to the next slide to define that. This is the obligation that the ESOP company will have eventually to provide liquidity to the employees who hold the stock as beneficial owners in their ESOP accounts. Employees will have their allocation of shares, which is generally structured on the basis of a set percentage of their aggregate W-2 compensation. So an employee who has a $100,000 wage will have twice as much as an employee with a $50,000 wage with a uniform percentage. The ESOP requires that the sponsoring employer provide employees with liquidity, and that liquidity is defined as a time frame that occurs within 1 year of retirement, death of the participant, or disability, or following a 5-year termination period for an employee who terminates with the company after after a period of employment and securing a vested right in the ESOP, but before normal retirement age. Next slide. For those, employees who are entitled to a distribution, as well as the employees who are entitled to the diversification opportunity at age 55 and 10 years of employment, it is the obligation of the employer or the ESOP to acquire those securities under a fair market value formula. And that is why the ESOP is mandated to have an annual valuation of the ESOP shares. And that value is determined annually. It can increase, it can decrease over time. However, the right of the participant employee is to receive the current market value at the time that they're receiving a distribution. And the repurchase obligation can be estimated based on the demographic of an ESOP company's employment workforce, and oftentimes that estimation is critical to the ESOP company to say the combination of the tax deductions that we can receive for making contributions to the ESOP, the obligations to repay the selling shareholder, and then the future obligations to employees fit well within our budgets. Let's go to the next slide. David, do you want to return to fiduciary issues?
We'll move to the next slide, and we'll talk about corporate versus ERISA fiduciary standards. And we'll go over this a few different slides here before we try to wrap up with the pros and cons. But before we do that, one of the things we haven't talked about is the players, and maybe we should have had a slide in terms of the players involved. Typically, what you've got to have is you've got to have an ESOP advisory team, and that ESOP advisory team typically involves either a group of individuals who serve as a board of trustees for the ESOP, or a institutional trustee, an independent discretionary institutional trustee. That trustee is the one who has this high ERISA fiduciary standard that we start to talk about on page 45. The trustee or trustees select the independent appraiser and financial advisor for the ESOP, who helps the trustee determine whether or not the ESOP's paying more than fair market value, which obviously they can't, and then makes the good faith determination of what price the ESOP should pay in the first place for the stock that's purchased by the ESOP trust. The trustee also selects independent legal counsel, and that independent legal counsel represents the ESOP. A lot of people in the ESOP community are confused by this, even people who have been doing this work for 30 or more years. They continue to have institutional trustees who hire their own counsel to protect their own interests rather than the interest of the ESOP itself. So what Rachel and I do in our practice is we typically come up about this from the corporate side. We're representing the corporation. We're advising them how to set this up, advising them the compliance standards under ERISA, et cetera. And in doing so, we like to see the corporation identify an individual or entity to be an independent fiduciary, separate and apart from the founding shareholders and the corporate officers and directors, who will then be responsible for selecting the institutional trustee or the board of trustees, and then will monitor the conduct of that individual or institutional trustee. And then, as I say, our perspective is that the institutional trustee should be representing the interest of the ESOP, not themselves, and their counsel shouldn't be representing themselves, the trustee, but should be representing the ESOP. I think this one has gotten out of whack in the ESOP industry, and Rachel and I have attempted to reorient the discussion in this respect in the way that we just described. So that's your ESOP advisory team. It consists of the trustee or trustees, the independent legal counsel for the ESOP, not simply for the institutional trustee, and the independent appraiser and financial advisor for the ESOP. Again, that independent appraiser and financial advisor for the ESOP is not working for the benefit of the trustee, the institutional trustee. They should be working for the benefit of the ESOP. And that's what we start to talk about, the highest standard of prudence, skill, and care here for ERISA fiduciaries, and not looking at their own interest, not the institutional trustee's own interest, which it seems like that's what happens in the ESOP world these days, is that the institutional trustee spends more time trying to protect themselves from liability instead of identify what's in the best interest of the ESOP. And that's the standard that we like to see applied in the course of these transactions. Next slide, please. We have to avoid conflicts. So this is why Rachel and I advise our corporate clients to not have people serve if at all possible, on the board of directors and as an ESOP fiduciary, because you do have a natural conflict there, and it's hard for that person who's serving both as an ESOP fiduciary and as a member of the board of directors to meet the general standard. A board of directors has a responsibility to all shareholders. So if an ESOP does not own 100% of a business, and let's say you've got a 30% ESOP owned company and then 70% of the stock is owned by other shareholders, query how a member of a board of directors of an ESOP company can meet their responsibilities to the ESOP as the shareholder as well as the 70% shareholders who are non-ESOP shareholders. So again, hence why we advise that corporations go out, appoint this independent fiduciary. The independent fiduciary hires an institutional trustee, and the institutional trustee hires legal counsel for the ESOP and the independent appraiser to look out for its best interests. Next slide, please. Another thing I guess we just want to say here is that you can have unintentional ESOP or ERISA fiduciary responsibility. The plan, if you're named in the plan document or a trust agreement as an ESOP fiduciary or an ERISA fiduciary, you are, unless someone didn't tell you. I mean, there are cases in which someone has been appointed as a trustee and they didn't know, and in that case, you really can't have ERISA fiduciary responsibility. But if you're named and you know you're named, then you have a responsibility to understand the plan documents and trust instruments and really exercise the highest standard known to mankind. It's not a reasonable business judgment standard as applied to board of directors under corporate law in any state of the union. It's simply the highest standard known to mankind. And then you potentially can have, you can exercise discretionary authority and control over the management or disposition of plan assets, and you're an ERISA fiduciary. So query whether or not you're an officer of the company, you're the director of acquisitions of a company, and you go out and you have direct communications with the independent appraiser and financial advisor for the ESOP. You're not a named fiduciary, but you go ahead and you influence the price at which a transaction is occurring between a company and a party in interest, or between an ESOP and a party in interest. So now you've influenced the transaction value that is going to be paid to or paid by an ESOP trustee. As a result, on behalf of the ESOP, I think you've become an ERISA fiduciary. And that could happen to members of a board of directors of a company. It could happen to an ESOP advisory committee. It could happen to company executives. It could happen to outside advisors. It could happen to the independent appraiser and financial advisor for the ESOP. The legal counsel for the ESOP, we've seen some legal counsel for ESOPs take aggressive moves in representing the ESOP, which suggests that they're making independent discretionary decisions over the transaction. Just query whether or not that makes them an ERISA fiduciary. So Rachel, before I go on to the next slide, do you have anything more to add generally in that sense?
I think the important thing for potential ESOP sellers to keep in mind here is that the fiduciary roles can be well defined in documents that are properly drafted, that the parameters of involvement and influence are, very important to have defined both in the ESOP documents and in any transaction documents for an ESOP sale. There are significant risks associated with not paying attention to this highest level of fiduciary standards, but it also is a standard where the duties can be allocated appropriately to an independent trustee to make the decisions so that the selling shareholder can stand to the side. The ESOP corporation can just address its knowledge with respect to the transaction, and these matters can be carried forth in an appropriate manner to minimize those risks. But it has to follow the terms of the documents and whatever role an individual has been assigned under those documents.
Yeah, and that goes, if we could go to the next slide, slide 48, that goes to Rachel's point there. You know, a key for any ERISA fiduciary is follow the plan document unless ERISA requires that you override the terms of the plan document, which very rarely does ERISA provide that. Protect the plan from non-exempt prohibited transactions. Don't pay more than fair market value for the stock. Don't get involved in any real conflicts of interest. You know, we've had cases where independent institutional trustees are asking us to talk with the independent appraisers and financial advisors for their for the ESOP and asking us to negotiate the terms of their contract. We don't want to talk directly as corporate counsel to those individuals. We want the trustees involved and to be negotiating those contracts directly. Typically, there are corporate responsibilities related to those contracts, but you should not have those independent communications. Again, a non-exempt prohibited transaction would be a transaction in which the ESOP pays more than fair market value for the company's stock. That's one thing we obviously want to avoid. Get a thorough due diligence report completed. Have a very intensive analysis of the fair market value of the company. Make sure that the independent trustee and institutional trustee and or members of the board of trustees of the ESOP understand the terms of the valuation report and how it works and how the company value was derived for purposes of the transaction. Don't have selling shareholders be involved in providing information to the independent appraisers and financial advisors of ESOP companies for purposes of establishing the value. A lot of simple rules. Unfortunately, what all of this tells you is it's a highly regulated environment, and therefore you have to be very careful on how you proceed with an ESOP transaction, and ESOP transactions tend to be more complicated and maybe a little bit more expensive than a typical sale to a third party. Let's go to slide 50. Again, we're getting close to the wrap-up stage here, and we'll cover any questions at the end if there are any. But slide 50 talks about conflicts of interest. We got to look for conflicts of interest between the company and the ESOP, the managers of the company and the ESOP, the board of directors of the company and the ESOP. A lot of times what we'll do for a board of directors, or what we'll do in advising our corporations with respect to an ESOP, is that the board of directors should have a couple of outside members on its board of directors serve as an ERISA fiduciary committee to the board, which would essentially have the responsibility for interacting with any ESOP and ERISA fiduciaries and overseeing, or not overseeing, but just have general oversight and review of their conduct to make sure that they're completing their tasks in a way that's consistent with ERISA. A lot of simple ways to avoid conflicts of interest. If there is one, have that individual resign, appoint independent advisors, outsiders, committees, abstain from action. The best thing to do, though, is just keep the selling shareholders, founding shareholders out of the process. Keep the board of directors, the inside board of directors out of the process. Involve outside boards of directors, appoint an independent fiduciary at the corporate level who is responsible and outside of the company, yet maybe an officer of the company for purposes of interacting with the ERISA fiduciaries on the other side of the equation. Let's just talk for a minute on slide 51 about the general regulatory framework. If we could, next slide, please. General regulatory framework for tax matters is typically the Department of Treasury and the IRS, and Rachel and I have seen many audits over the years in that respect. Typically, those are just focusing on tax deductions and taxable income, and not so much the fiduciary side of the equation that the Department of Labor will focus on through its primary division, the Employee Benefit Security Administration. ERISA is the governing body, and there are proposed regulations that the Secretary of Labor has refused to finalize since May of 1988 that deal with the fair market value of an ESOP company or stock held by a qualified retirement plan, rather. So just be prepared to be investigated, reviewed, and/or audited if you create an ESOP, and understand that it's part of the whole charge of creating the tax deductions and other employee benefits and equity incentives that are associated with an ESOP. I'd like to move now, I guess, Rachel, could you pick up at slide 52 and I think take us through the rest here before we get briefly to pros and cons.
Great. The ESOP structure is dependent on the tax qualification of the ESOP. The tax qualification is determined by the IRS. It requires the ESOP to comply with the standard rules for eligibility, for vesting, time frames for the distributions that we require to provide the liquidity to the employees, and the IRS looks to that, and if the ESOP is tax qualified, the benefits of the deductions we've described exists. For an S corporation that is 100% owned by an ESOP, the tax-exempt status of that ESOP sponsor is permitted, as David had described, since the 1990s, so that income can be received free of tax. On the other hand, there are dire consequences if the ESOP is not qualified. Those deductions are not available. The employees do not have the ability to roll over into an individual retirement account. Potentially, there's immediate income to the employees, various penalties. If we turn to the next slide, there's a mechanism for ensuring that the documentation for your ESOP is approved by the IRS. The IRS operates on a 5-year application cycle and issues individual letters to ESOP companies that confirm that the plan documents are on their face qualified and satisfied the qualification requirements. There's a significant application fee for this, a base fee of $2,500, and for many of the specialized tests, the application fee can be increased. If we turn to the next slide, there has been a recent development with the IRS. They are permitting pre-approved plans for ESOPs to be permitted. Those pre-approved plans can be submitted by organizations that do lots of ESOP drafting. For example, our firm will submit a pre-approved plan to the IRS to address, and that allows ESOP sponsors to greatly reduce their application fee and to allow the process to be less burdensome in the form of an individual application. The IRS revenue procedure that has announced this has a number of ambiguities. We've been told by the IRS that we are the only firm that has raised questions with respect to those ambiguities and how ESOP sponsors can rely on the pre-approved structure. So this is an evolving area, but is an area that will help in terms of compliance. Turn to the next page. The ESOP itself also has the compliance of an annual return, something equivalent to a tax return on IRS Form 5500. This is where the annual valuation for the ESOP is reported to the government, the number of participants, the amount of the distributions that have been made. So this is really a disclosure document that assists the enforcement agencies, the Department of Labor, Office of the Chief Accountant, and the IRS examine what is happening for ESOP plans. This is a similar requirement that is applied to any type of retirement plan, including a pension plan or a 401k plan. Let's turn to the next slide. There are also communication mandates for ESOP companies. There's a summary plan description that requires the terms of the ESOP to be explained to ESOP participants in a manner designed to be understood by the participants, and that gives an ESOP sponsor the opportunity to educate its employee owners, but you're also complying with the requirements associated with that. There is an annual statement of an account and a summary of the information on the 5500 that's generally included on the back of the participant statement that goes to participants. These are mandated communications. Most ESOP companies use these communications to communicate the benefits of employee ownership to their workers, that you can participate in the profitability of the company and potentially impact the share price for the ESOP. So that certainly is a required disclosure. Let's turn to the next slide. Prohibited transactions. These are the same types of conflicts of interest that David described that need to be monitored on an ongoing basis with respect to the ESOP. They're, at the time of an initial ESOP transaction, compliance with the mandate that the ESOP not purchase at greater than fair market value is addressed by the appraiser for the ESOP trustee, and then on an ongoing basis, any related party transactions need to be examined under these prohibited transaction rules. And there are a number of regulatory exemptions from those rules. There's the ability to obtain an administrative exemption. For example, if the selling shareholders wanted to sell real property to the plan itself, individual administrative exemptions are permitted. Turn to the next slide. A failure to address any of these related party rules, these prohibited transactions, can result in severe penalties, not just disqualification, but excise taxes, sanctions, contributions, and interest and penalties. That's the bad news. The good news is on the next page that both the next slide, please, that both the Internal Revenue Service and the Department of Labor have implemented broad corrective programs that allow ESOP sponsors and other retirement plan sponsors that determine that they have had an inadvertent failure to comply with any of the types of regulatory provisions that David and I have described, the opportunity to go in, to correct those, and to address those issues in a manner that allows the ESOP company to move forward, correct the issue, and proceed with a compliant ESOP. These are very broad programs that provide ample protections to most ESOP sponsors and allow most ESOP sponsors to resolve significant questions that will be provided. Finally, on the next slide, let's cover one of the myths associated with ESOPs. We hear oftentimes when people are considering ESOPs, well, we don't want to get rid of that 401k plan. Our employees are used to our 401k plans. They like the benefits associated with the 401k. I don't want to move forward with the ESOP because we don't want to eliminate the 401k option. That is still present with an ESOP plan, there's no limitation on maintaining both an ESOP and a 401k. Certain contributions and individual limits need to be examined in the aggregate with an ESOP and a 401k, but an ESOP company can maintain a 401k plan and continue that for the benefit of its employees. And with that, why don't we turn to the next slide? And David, would you like to cover the pros and cons here?
We're going to wrap up here in the next few minutes. Just let's go through a summary of ESOP pros and cons. I think you've heard it, but this is intended to be clearly this isn't a sales pitch. An ESOP doesn't work for everybody. It may not make sense for you. We've described the places where we think there are regulatory concerns that may be impossible for you to overcome and may not work for you in that respect. We've described the complications of an ESOP, the regulatory environment, the cost of an ESOP. All of those are things that may make one consider to go down another path. But let's go over the pros and cons for a few minutes before we wrap up today. From the shareholders, selling shareholders or founding shareholders perspective, the pros, you got a potential tax deferral. You also have a viable exit strategy where you take money out of your company on a periodic basis and become liquid and diversify your investments into some other form of investment from a closely held company over a 5 to 10 year period of time. That's what an ESOP can help you accomplish. There is going to be dilution to other shareholders. That's one of the cons. If I'm not selling to the ESOP, do I want to accomplish a transaction? Do I want that stock for my benefit and not to have it go to the ESOP? Next, from the corporate perspective, tax deductions, we've talked about them. There are substantial tax deductions for employer contributions and deductible dividends for a C corporation. It's a very good to an exceptional tool for cash flow management, recruiting and retaining employees, business succession, mergers and acquisitions. All of those are things that a corporation can use an ESOP for. On the con side, as I talked about, plan administration costs and expenses, you're going to have an institutional trustee, most likely minimum of $15,000 to $20,000, maybe more for the initial transaction, and then that cost will go down after that. You're going to have legal counsel for the ESOP, another, $10,000, $15,000, $20,000. Independent appraiser and financial advisor for the ESOP, again, a minimum of $15,000 to $20,000 to start out. So these are not small expenses, and you really have to weigh the tax benefits of accomplishing the ESOP and the tax savings relative to these substantial costs and the administrative and compliance responsibility and ERISA fiduciary liability associated with an ESOP. Balance sheet impact, the debt incurred to accomplish an ESOP transaction, and by the way, I'm on slide 62, so if we could go to that slide, thank you. The debt that's incurred to buy stock from selling shareholders appears as a contra equity account for leveraged ESOPs only. That's going to make your balance sheet look pretty bad for the first few years. You're going to have the debt not only be booked as a liability, but it's also going to be booked as a contra equity account. So all of a sudden you're going to sap all the equity out of your business, and your bank is going to look at your financial statement and say, hey, what's going on here? This doesn't make sense. You're going to have to live with that. That debt, that balance sheet will recover over time as the profits are earned to pay back the debt that was incurred to buy the stock in the first place. Slide 63, please. The next, from the employee's perspective, no wage reductions, no contributions to pay back the debt. You don't have to guarantee the debt that's incurred to buy the stock. You don't have to have the financial ability to buy the stock in the first place. And that's typically why ESOPs happen, is because people collectively can accomplish more than individuals can. So that's why the ESOP concept is used. Opportunity to provide input. The employees do get to vote on major corporate, or direct the vote with respect to major corporate issues. A lot of the companies we work with engage in open book management right away after they accomplish an ESOP. not to make a commercial, but Jack Stack wrote a book about the great game of business. We had one client who just automatically put that in as soon as he put his ESOP in place for his employees. Benefit payments are eligible for favorable tax treatment. The employees can roll their cash benefit from the ESOP out to an IRA and avoid taxes, and then take the money out of their IRA when they need it for retirement. The one major con from the employee's perspective is there's no guarantee of benefit. Although the Secretary of Labor and its agents would like to say that you have to guarantee the value of the stock that's sold to the ESOP, that's not the law. It's nowhere near the law. That's also the view of the private plaintiff's bar, and it's not required. There's no guarantee. That said, I strongly urge you not to consider doing an ESOP if you're worried about that fluctuation of fair market value, and if you have any concerns about the fair market value of the company continuing over a period of time. Concluding remarks on page 64, slide 64. Please, next slide. Company's board of directors has to carefully consider this subject matter, establish and document procedural prudence in all of its decisions, educate key decision makers with respect to both corporate and ERISA fiduciary responsibilities, consult with an expert team, have an expert legal counsel advising the corporation, get separate counsel for the selling shareholders, establish an ESOP advisory team first consisting of an institutional trustee, legal counsel to the ESOP, valuation expertise for the ESOP, bring in an accountant who is well-versed in ESOP accounting matters and financial matters, and have that team work cohesively together in an arm's-length transaction to accomplish great benefits for selling shareholders, employees, and the corporation. At a minimum, maintain adequate directors and officers in ERISA fiduciary insurance in case something doesn't go exactly right. If the market drops unexpectedly and yet you accomplished an ESOP transaction right before it dropped and you had no inkling that that was going to happen and that impacts your deal and somehow have the insurance just to protect you in that respect. Read and understand the ESOP plan documents and trust agreements. And as I said, when I first started doing this 33 years ago now as a law clerk in St. Paul, Minnesota, what attracted me to ESOPs was the ability for selling shareholders, founding shareholders, corporations, employees, and their management teams to align all of their interests in the same direction and accomplish a transaction that benefited not just one component of those folks, but all of them, the selling shareholders, corporations, founding shareholders, employees, and management. If we can align all of their interests together and communicate that properly throughout the business, an ESOP is and can be right for you. Thanks, Rachel, for speaking with me today, and everyone for joining. We're available for questions if there are any, Elizabeth.
Excellent. Thank you so much. We've covered so much information, and attendees, again, if you do still have questions, we do have time for a few of them. Just use that chat window there on the lower right-hand side of your screen. Additionally, you can contact each speaker individually on the events materials that have been provided to you also. Question that's coming in, if we could just get a little bit of clarification on this, even if it has been covered. Do the ESOP trustees elect the entire board of directors?
They do. Thanks, Elizabeth. That's a great question. It depends on how much ownership there is, but if an ESOP owns 100% of the business, then the ESOP trustee does elect the entire board of directors. If an ESOP only owns 30% of the company, then the ESOP may not elect any directors, and if there's cumulative voting, may only elect one or two directors. So it really depends upon the facts and circumstances, but if it's 100% owned ESOP corporation, then the trustee is going to elect the board of directors. Elizabeth.
Okay, great. Another one, to what extent is the expected impact of the employer's contributions to the ESOP, which was used to acquire shares of the company's stock, to the company's cash flow availability on a post-transaction basis?
Rachel, would you like to take that one?
Sure. This is where the tax deductions really create the fuel for the ESOP. The corporate cash flow will be used to pay for the ESOP stock. In this example, a leveraged sale where there's an ongoing loan obligation, and that cash flow will certainly be diminished by the ESOP contributions to pay the loan. However, the deduction will also be, the deduction that's available for that contribution will also decrease the taxable income that the ESOP sponsor will need to report to the IRS, to the state tax authorities, and in turn reduce that tax liability. So generally speaking, it's the reduced tax liability that enables the corporation to make the sizable contributions to fund the ESOP itself.
Thank you so much. And what can possibly drive the declaration of S corporation distributions when selling to an ESOP?
Could you restate that, Elizabeth?
Sure.
I didn't quite follow that one.
Yeah, the question coming in from them are, what could possibly drive the declaration of S corporation distributions when selling to an ESOP? And we can certainly ask that attendee for clarification.
Yeah, well, I'll try to answer it, and if I don't hit it, clearly what happens is when an ESOP owns stock in a corporation, let's say an ESOP owns 30% of an S corporation, it's got a right by law to receive 30% of any distributions that might occur with respect to the profits of the corporation. So if there's $1 million worth of earnings and the corporation's board of directors decides to distribute $500,000 and the ESOP owns 30% of the S corporation, it's going to get 30%. I think the question is, what causes the board of directors to make the decision to distribute those earnings to the ESOP rather than use them for corporate purposes? And that really is not an ERISA fiduciary matter. That's a corporate governance matter of a corporation and its articles of incorporation and bylaws in the state in which it's organized. And that corporate board of directors has to decide what's in the best interest of the corporation and its shareholder, not under ERISA, but under corporate law. And the corporation may decide that it's better to retain that cash for operations than put it into the ESOP in the form of a distribution. But that was a really good question, Elizabeth.
Excellent. We have a few more we'd like to try to get in before we hit the top of the hour here. Another question coming in here in the time we have. We'll see if we can get a few more of these done. What are the benefits of planning for future payment obligations to terminated employees and repurchase obligations with respect to terminated vested ESOP participants, which makes them highly recommended?
I'm going to defer that to my well-qualified partner who loves to talk about that subject matter.
Thank you, David. And quickly, the benefit of planning is that the ESOP and the sponsoring corporation can accurately budget and project those costs and then better understand how corporate cash flow will be applied in future years. Sometimes that planning process has the impact of accelerating or decelerating within the Internal Revenue Code guidelines the timing for distributions. And by knowing more information, the decisions of how to impact the timing of distributions within the permissible limits can often be better tailored to that corporation.
Excellent. Thank you so much. And how can participants be granted a right to acquire company stock at a future date?
I'll jump in on that one. Participants themselves typically can't be granted that right within an ESOP. If they did, then we would have a bunch of securities law issues to cover, and we'd have to look at Rule 701 of the Securities and Exchange Commission and accomplish exemptions and have information statement and prospectus basically going out to the employees. So typically ESOPs are not the type of vehicle where we're going to see employees make the decision to buy stock on a day-by-day basis. There are decisions to diversify. An employee may sell after they reach age 55 and 10 years of participation in the ESOP. But typically we don't have a lot of decisions for employees to buy stock in a company within an ESOP. I don't think it's a bad idea, Elizabeth. I think it's a great idea. But if it's done, you've got to invest a lot of money and time in creating the right information statement, prospectus, and meet these securities law requirements, and then put cash in employees' accounts so they can buy company stock. We've seen a lot of ESOPs combined with 401k plans, and we've seen a lot of litigation associated with those plans. I'm not opposed to them, but they have to be done. Buyer beware and make sure that you accomplish the right regulatory requirements.
Excellent. I think we have time for just one more question. If we can answer it quickly, we'll be able to get this question in here. Possible circumstances which can be considered to reduce or disregard the sanctions for late or non-filing of annual return.
Rachel, I'll let you finish.
Right. If one determines quickly, there's a comprehensive delinquent filer voluntary correction program that has penalties that are literally a tiny fraction of the potential penalties. If the determination is later, counsel to assist in a reasonable cause analysis is important to limiting the penalties that can be applied.
Excellent. Thank you so much. Thanks to both of our speakers today. Excellent presentations from Mr. David Johanson, Ms. Rachel Markun. We have covered a lot. And again, attendees, if you do have additional questions, please feel free to reach out to the speakers individually. That information is on your events material. So a reminder again on the survey coming to you. If you are applying for continuing education credit, completions of the surveys are mandatory as per your state boards and bars. We do invite all of you to follow us on Twitter at @no_group. Find out more about upcoming events, our unlimited programs, and the outsourcing services that we offer to help save your firm money. Ladies and gentlemen, this does conclude our event for Employee Stock Ownership Plans, Pros and Cons live webcast.